Welcome to this video on Elliott Wave Theory Analysis versus objective trend trading indicators. I traded Elliott Wave Theory for a while, a couple of years actually. Had a teacher who was very successful, consistently profitable, so I'm definitely not here to trash Elliott Wave Theory. My opinion on it is that it started out with a observation on how markets tend to move, seeing repetitive cycles of 5 impulse moves and then 3 corrective waves. And I think that yes, the market does move that way a lot of times, but not all the time. And so like a lot of good things that start with some good concepts, then people turn them into dogma and impose that dogma on reality. And that's where things get messed up. And in my opinion, that's where Elliott Wave gets messed up. People start to make it into where the market's got to always fit a certain rigid structure. And the market doesn't do that. You know, the market is a wild animal. It's like a wild tiger. It's not like a little tame purse puppy that you can tame. So the markets are going to do what they're going to do, and they don't always follow the same patterns. And so the way that I count waves, and the way that I count cycles, and the way that I measure trends is really just very mathematical. And certainly there's been people who have attempted to create objective measurements for Elliott Wave, and I've seen them. But still, the way that I do this is the way that I prefer it after experiencing many different types of approaches. So here it is in basic. Number one, when we define trend, understand that the word trend means the extended general direction. So very important to understand that that is actually literally what the word trend means, is the extended general direction. That's Webster's dictionary definition of the term. So, for example, you could have a higher high and a higher low, and some people define this as a trend. That is not a trend. That is not a trend. That breaks the dictionary's definition of the word trend, because you could have the market coming down before that and then going down after that. And this is simply a complex retrace in an overall downtrend. The extended general direction of this market would be down in this case. Therefore, the trend is down. Therefore, higher highs, higher lows does not define trend. That is wrong. So we need when we're going to use a trend trading indicator, we need something that measures the long-term move of the market. And there's many good choices. I don't think there's one that's, superior to all the rest. So I like to keep things simple. I just use a moving average, the 50-period simple moving average. It fits the definition of the term trend, number one. And it also is a very commonly used moving average, perhaps the most commonly moving average that there is. And therefore, there's a self-fulfilling prophecy to it based on mass psychology. So especially on daily and weekly charts and monthly charts too. So I measure trends. So for example, sometimes the market will go into a trendless cycle like this, where it's just not really going anywhere, not up, not down. And the 50 MA pretty much goes flat. And then the 50-period simple moving average starts to go down. And we see that starting to angle down. And then we count our cycles and our waves, 1, 2, and then we get, and this is similar to Elliott Wave, we'll get our little ABC patterns here as the market puts in cycles. Now this down here is my cycle indicator. So when you're measuring cycles, there's two different things. There's cycles and there's waves. So this indicator measures cycles, but you have to measure cycles before you can measure waves. So I don't have time to go into all of the details about my cycle indicator, but I do give this away for free. Just send an email to barry@topdogtrading.com, and I'll show you how to get that for free. This is actually just part of it. I just want to show you the bare bones structure of it here to give you the idea right now, because today we're not really talking about cycles, we're talking about trend. But they are related, and so this is the way that I count waves. So here's a wave 1, 50 MA. Wave 1 is defined as the first cycle low after the 50 MA turns down. So that's where I start my wave count. So is that a little bit late to the party? It is. Trend is always a lagging indicator, And that's because you have to wait for a certain amount of data to be collected in order to measure the extended general direction. If you start too early, you're not measuring the extended general direction. So you have to let some time go by. And that's why it's a lagging indicator. All right, wave 2 here. Whoops, wave 2. Now, we don't get a wave 3 here. Why? Because that is a cycle low, and that's a cycle high. And that's a wave 1, and that's a wave 2. The reason this is not a wave 3, but wave 3 occurs over here, is because a wave, the way I define it, as different than a cycle, has to make a lower low. In other words, a wave 3 has to make a lower low than wave 1. And since this does not, therefore it is a cycle low, but not a wave low. That's the difference. So every wave is a cycle, but not every cycle is a wave. So waves define counting how, and this is why waves are so important in trends. It counts how far you are along in that trend. So I'm sure you've heard the term, the trend is your friend until the end. Well, what that's instructing us on is to know how early or late you are in a trend. You only want to trade early in a new trend because the later the trend goes, it's not your friend anymore. It becomes your enemy, actually. That's when we start looking for trend reversal trades. Trend is your friend early in a new trend. So I would love to trade a wave 2 in a new trend, and that's what I do. That's the early trend trade that I can get. All right, now we have trend reversal trades. You could have gotten in before this on a trend reversal trade, etc., but these are very, very reliable. So let's define where does wave 3 come in. Now, here's another thing that people will tell you that I disagree with, and it goes back to the higher high, higher low, higher high, higher low thing. Okay, higher highs are an oversimplification, so it's not necessarily important. For example, in fact, it can be deceiving. It can be a bearish pattern. So here we have lower lows, all right? And the way I have to define a wave 3 is we take this and we look at, let me bring up my drawing line here. I'll take that low, I'll draw it straight across. And in order for this to be a wave 3, wherever a wave 3 is going to come in, not only does it have to be a lower low, but the open and close of the bar have to be below wave 1. So here we have, this is the start of where we could start a wave 3. It ends up putting in its low here. Notice the cycle indicator stays down below the mid-range of the indicator this whole time. And that's something to understand about cycles. Cycles are not even. They expand and they contract, and sometimes they actually disappear. If you've ever understood or studied cycle theory in detail, then you understand what I'm talking about. All right, so again, now here we put in a wave 5. Now, counting waves this way, your average wave count is a wave 5. So that's great, all right? But let me show you something else. So we get a higher high here. My line's just a little bit off there, but you get the idea. So we get a little higher high here, but where does it close? It closes and opens and closes below the high of wave 1. Therefore, we call it a failed 3. And that's called a rejection of value in market profile theory, saying that, yeah, the prices went up here, but it didn't close up there, so therefore it's really not bullish yet. In fact, the market rejected these higher prices. Now, that's just temporary. It can turn around. In fact, it did turn around here. And another thing to look at is the range of the bars. All these bars here are very narrow range. So it really just means, you got to look at all these things here. So it really just means the market's really hesitating here. There's no strong movement to the upside or the downside for that matter. It's just kind of going sideways. So we don't impose any, major influence or structure on the market. We just understand that, okay, pretty much going sideways. Then we start getting some more wide range bars. Alrighty, and then it starts finally going up. And these wide range bars are more significant. Then again, it starts to put in narrow range bars, and we get some sideways movement. So we put a wave 3 here. because this is the highest high, where we do get, and the easiest way to think about it is just the real body of the candlestick above what? Above the high of wave 1. So that's a significant higher high, right? This was not significant. That is. Now the market's really trending. Now it's really making a move up. Okay, and then we get a wave 5. So again, that's a failed 5. This is just, now we acknowledge our cycles. And the cycles are just timing. The cycles do not tell you how far the market's going to move. And so we get a little cycle low here. We get a little cycle high here. We get a little cycle low here. But again, overall, what's the market doing? Just kind of going sideways, not really going anywhere. So time's going by, and the oscillations are happening, and that's purely what the cycle indicator measures, is time. But then you need to coordinate that with your trend for direction. In other words, you don't want to short a cycle high when the trend is going up. And again, what else? It's not late in a trend. We'd only want to do that if it got real late in a trend, beyond an extended trend. So the average trend is 5 waves. Still not going to short that. Why wouldn't I? Because that is the average trend. I don't want to trade the average. I want to trade beyond the statistical average. All right, and then look at that. We put in a wave 7. Wait a minute. I thought you're only supposed to be able to put in 5 waves. No, that's an Elliott Wave rule. But to me, again, the markets are going to do what they're going to do. I'm not imposing an outside expectation of how many waves it has to put in. So the way that I'm doing this is mathematically objective. There's no guesswork. There's no assumptions. There's no subjectivity to it. You've got a cycle indicator that's mathematical. You've got rules based on price structure, that's mathematical, and everybody gets the exact same wave count. So this can actually be programmed into software. And look at that, we put in a failed 9, and then we put in a real 9, and we put in an 11. So this time the market said, you know what, I'm really going to rock and roll here. And that's the way markets work in real life. Sometimes they go into big, huge trends that, man, you're going to have to be real creative to try to fit that into a 5-wave pattern. And it just doesn't, in my opinion, make much sense to try to impose or reduce a big trend down to 5 waves and then expand little trends into 5 waves when really those two trends are very different things. Why not number them for what they are, either long trends or short trends, and to put numbers on them so that we can identify whether we're early in a new trend, late in an old trend, and make it all very objective so that we're all seeing the same thing and there's really no guesswork to it at all. So if you like this video, please understand it's not free. Yes, if you got value from it, you actually have a moral obligation to pay it forward by clicking on the share button below. In addition, if you are watching this on YouTube, please click the thumbs up icon and leave a comment, because I really love your comments and they encourage me to create more free tutorials for you. Also, I'm giving away one of my favorite trade strategies called the rubber band trade that has a very, very high win-loss ratio. It's a simple trade. I can teach it to you in 26 short minutes. So get my rubber band trade strategy absolutely free by clicking on the little eye with a circle around it in the top right corner of this video. And if you're not watching on YouTube, there's a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.